Hello, everyone. Hope you've had a good week. I haven't posted one of these videos in a while, so I just wanted to run through some charts just to give an update of what's been going on in the stock market, just to summarize really, and give you some of the thoughts that I have at the moment, and potentially what's been going on. So to summarize here, let's start off having a look at a chart of the S&P 500. This is a 10-year chart, and as you can see, it's been going up very, very nicely since 2009. Just before the pandemic struck at the beginning of 2020, it was at a level of about 3,270. The pandemic then struck, panic set in, stock market sold off. There's a short and sharp crash. Went all the way down to a low of 2,182 thereabouts. At that point, the US central bank, the Fed, started quantitative easing, lowering interest rates, essentially pumping money into the system, and that caused a broad-based rally. They did that to really stimulate the economy because they knew that the lockdowns would be absolutely catastrophic for the US economy. So when they started doing that, the stock market had a very strong rally. Pretty much everything went up. And as you can see, it went all the way from 2,182 to a peak in January of this year, 2022, of just over 4,800. What has happened since then? Since then, we've had inflation. So things like the oil price, let's have a look at the oil price. You can see here it's spiked up dramatically since, again, when the pandemic struck. Just before it struck in 2020, the oil price was about $66. Then the lockdowns happened and the oil price absolutely collapsed. I'm not sure if you remember that, but at once, all the way down here on this chart, it shows $16. I think for a very brief period of time, it even went negative for a very short period of time. Then again, with the stimulus from central banks around the world, including the Fed, the stock markets rallied, the economy rallied, and you can see the oil price shot up as well. On the back of that. And then more recently, we've had the Russia invading the Ukraine, which has again caused the oil price to spike up even more. And now more recently, we've seen China reopening. So we've had a dramatic increase in the oil price all the way up to, at the moment, so about $121 per barrel. Now, that's obviously going to cause inflation. And so the Fed is now, and central banks around the world are very concerned about inflation. To combat inflation, what they do is they try to raise interest rates. And one of the ways they raise interest rates is by selling bonds. So for example, here we can see the US 10-year Treasury note. Also interesting, just before the pandemic, at about 1.91, then it collapsed sharply, and similar story. It's gained ground dramatically. So yeah, raising interest rates, and especially since the beginning of this year, it has spiked up again. Interest rates rising dramatically, and that is likely to slow the economy down, which I think is the Fed's intention. The concern at the moment is that more than slowing the economy down, it could actually lead to a full-blown recession. And that is the concern at the moment, that inflation could lead to a recession, and the higher interest rates the Fed might overreact. So what we saw, for example, on Wednesday night, the Fed raised interest rates again. A lot of people they originally said they were going to raise it by 50 basis points, 0.5%, but they actually raised it by 0.75%, 75 basis points. So they clearly are concerned that inflation might be getting out of hand. Now, what has that done to, just looking at other markets, for example, the US dollar? This is an index of the US dollar compared to other currencies. It has also spiked up, in the last few months dramatically. You can see from 90 to over 104. So the US dollar is getting stronger. And how has that affected stock markets in general? Well, here's a nice little look at the different sectors on the S&P 500. And as you can see, mostly, almost all negative, whether it's utilities, real estate, materials, IT, they've all been hit pretty hard. The only one that's done nicely really is the energy sector. So that's your oil and gas companies. Looking locally at the South African stock market, the larger companies' performance year to date, we've had coal mining companies like Thungela and Exxaro doing quite nicely. Sasol being in the oil industry and chemicals also doing very nicely, up 50%. The financials, like the banks, Nedbank, Standard Bank, doing pretty well recently on the back of interest rates rising. But then a lot of companies not doing so well this year. It's been pretty dismal for the performance of many companies. The likes of Richemont down 53% year to date. Prosus, Aspen, Mondi, Naspers, all taking a bit of a knock year to date. So just some other charts I thought I'd show of interest while we're talking about Naspers. Here's a chart of Naspers. As you can see, they had a very good run. This is a 10-year chart from 10 years ago. Had a very sharp, strong run all the way to a peak of over 3,800 thereabouts, and it's taken a massive dive in the last year and a half due to the Chinese government cracking down on tech companies broadly. Now, Naspers obviously has its valuation really is through Tencent in China. Naspers does seem to have reached a bit of a bottom and has started picking up here. So maybe one to keep an eye out on. Hopefully it's reached its bottom and can start regaining some value. As mentioned, obviously the Naspers chart and the Prosus chart will look very similar to Tencent. Tencent again got really hammered last year and seems to have reached a little bit of a base, hopefully picking up now. Some other ones to look at locally, Richemont, as mentioned, been a pretty dismal performer over the last year, but let's bear that in context though, because since 2020 it rose dramatically from about 131 Rand thereabouts all the way up to 248 Rand. And it's now got smashed down to 160 Rand. They did release results a couple of weeks ago. I thought they were actually pretty good. On the day, the chairman, Johann Rupert, mentioned that the slowdown in China due to lockdowns there might cause more damage to the Chinese economy than a lot of people are expecting. On the back of that, the share price dropped about 13% in one day. But it's actually recovered a lot of that drop. There we see it on the daily chart. That is the day that they released results. It dropped dramatically, but recovered most of those losses and now has started going down again along with the rest of the market. Still a great company, luxury brands, luxury goods. Timing is always difficult, but certainly a share that I would like to have in long-term share portfolios. Another one out of interest, jumping across to the gold sector, Gold Fields. There was also some news recently on this day here. You see the share price dropped 20%. because they made an offer to a Canadian gold company called Yamana Gold. They're going to be issuing shares to pay for that, $6.7 billion. The market was not too pleased about that. Share price dropped about 20% or so on that day. Has started to recover a bit, so just wanted to keep an eye out on. Then just something else I just wanted to discuss, going back to the American markets, looking at the bigger companies, the big boy in the block, Apple. So this is a monthly chart here, and you can see that again, going back to just before the pandemic started, Apple was at about $80. Then the pandemic struck, stock markets crashed, went all the way down to about $53, $54. The Fed started pumping money, same old story. I'm repeating myself, but the stock price of Apple really shot up from this low level of $55 all the way to above $180. So that is a dramatic increase. And now, of course, this year, with the unwinding of that stimulus, Apple has fallen from $180 to where it is now, $130. So I guess for it to get back to where it was at the beginning of 2020, it would need to fall back to about $82 thereabouts. I'm not suggesting that will happen or it needs to happen, but just to give an idea of where it was before the pandemic struck. Is Apple really justified at being at the level where it is now? I'll leave that to the analysts to discuss, but clearly there is the potential for a further pullback, and Apple being such a large component of the S&P 500, it could drag the rest of the index down along with it. So again, just keep an eye out on that. What's interesting, I noticed, was that while Apple has dropped, but still way higher than where it was before the pandemic, other large tech companies in the US, such as Facebook, here's a chart of Facebook. Now, Facebook is actually now below where it was before the pandemic struck. Before the pandemic struck, it was where we now there about $200 odd, whereas now it's at 160, just below $161. So really at a dramatic fall. Again, companies like Tencent, the whole Chinese sector are also at the moment below where they were before the pandemic struck. So quite a big disparity between some of the larger US tech stocks and the smaller US tech stocks, and especially the Chinese tech stocks, and pretty much everything else, as mentioned, except for your energy shares this year have been doing well. So where to from here? That's the $1 million question, and what should you do about it? So again, going back to the S&P 500, we could potentially see some further downside. As long as the US Fed is hawkish and looking at raising interest rates, that stimulus that was provided to give us this rally here is now gone. Coupled with that, as I mentioned, the markets are worried about a recession in the US and globally that possibly will happen, and that's obviously not good for equities. So a lot of bad news at the moment. Eventually that bad news will get priced into the market, and the market will be looking at offering value and being so-called cheap, but I wouldn't necessarily say we're at that level just yet. So what should you do about it? Well, again, if you're a very long-term investor and you've got a very long-term horizon, you could still maybe take advantage of going a little bit more into cash, but not necessarily panicking outright. If you're a sort of a medium-term or shorter-term investor, you could potentially look at going short and selling some of your shares just to realize a bit more cash. And then if we do pull back further, get back in. That's always the key, because you do want to get back in. As we all know, investing for the long term in equities is a great way of creating wealth, especially when companies unbundle. You could land up with 2 companies, as well as dividends that get paid along the way. And as you can see from a chart like this, you can perform quite nicely by investing in equities. So you're welcome to give me a call if you want to discuss further. I am a stockbroker and investment manager at AfriFocus Securities. My email address is warrens@afrifocus.co.za. Hope you enjoyed this video. If you liked it or found any value, feel free to share it with your friends, like and subscribe if you want, and send me some emails. I'd love to get your feedback. Also would like to know if there's anything else you would like to see from these videos, anything I should add, anything I should subtract, anything you'd like me to talk about, or maybe just discuss what I was chatting about in this video. Good luck on the markets out there. If you need any advice or would like me to manage a portfolio for you, I can do that. Have a great weekend. We'll chat soon. Bye.